Welcome back, crypto enthusiasts. Today we're diving deep into the intricate world of cryptocurrency chart analysis. To kick things off, let's understand the basics of cryptocurrency charts. There are three primary types: line charts, bar charts, and candlestick charts. Line charts are the simplest, displaying closing prices. Bar charts provide more detail, showing OHLC for each period. Candlestick charts, a favorite in crypto, offer a visual feast with bodies and wicks, revealing open, close, high, and low prices. Timeframes matter. From minutes to years, charts provide insights based on your investment horizon. Short-term traders prefer shorter frames, while long-term investors look at daily or weekly charts. Now, let's delve into the art of reading candlestick charts, a skill crucial in the crypto world. A green candle signals bullish if the closing price is higher, red, bearish if it's lower. Colors speak volumes in crypto. Recognize patterns. A hammer suggests reversal. Doji signifies market indecision. These patterns unlock the secrets of potential market moves. Moving on to the backbone of chart analysis, technical analysis. Identify support and resistance. Support halts downtrends due to demand, while resistance can signal a trend pause or reversal due to selling interest. The trend line is one of the most powerful tools for technical traders, especially for the majority who engage in short-term swing trading. Why is the trend line such a crucial tool? The potency of a trend line doesn't solely come from the gains it generates for its users. Instead, it lies in the numerous hidden facets within its simplicity that make it so valuable. By incorporating just one trend line into your chart, you can assess the trend, momentum, support, resistance, and entry points. How to draw a trend line. Simple geometry dictates that we need 2 points to draw a line. That's precisely what we need to create a trend line. How to draw a bullish trend line. Step 1. Select 2 support points on your chart. Step 2. Ensure the last point has a higher price value. Step 3. Connect the points together, aiming for the line to avoid passing through other price bars. Step 4. Extend the line to the right. Step 5. Congratulations! You've just drawn a bullish trend line, a valuable asset for analyzing trends, momentum, support, resistance, and entry points in your trading strategy. A moving average is the average price of a futures contract or a stock over a specific period. This can be calculated either manually or automatically through software. Moving averages are often used to assess where the current price of the underlying instrument stands concerning support and resistance on a chart. If the price moves down or up to an average line, traders may interpret this as a signal that the price could pause or reverse at that point. Traders can also visualize short-term and long-term support and resistance on a chart by adding moving average lines of different time periods. Let's spice it up with indicators and oscillators. The Relative Strength Index, RSI, is a momentum oscillator that measures the speed and change of price movements. The RSI oscillates between 0 and 100. Traditionally, the RSI is considered overbought when above 70 and oversold when below 30. Signals can be generated by looking for divergences and failure swings. RSI can also be used to identify the general trend. The moving average convergence to wire divergence, or MACD, is a momentum indicator that illustrates the correlation between two exponential moving averages, EMAs, of a stock's price. Convergence takes place when two moving averages approach each other, whereas divergence occurs when the moving averages move apart. This indicator assists traders in gauging whether the stock is experiencing significant buying or selling activity. Its effectiveness in identifying and evaluating short-term price movements adds substantial utility to this indicator. Bollinger Bands are a popular type of technical price indicator, consisting of upper and lower bands on each side of a simple moving average, SMA. Each band represents two standard deviations from the market's SMA, highlighting support and resistance levels. Traders often consider Bollinger Bands as an accurate measure of market volatility, where wider bands indicate higher volatility and narrower bands suggest stability. Traders also monitor Bollinger Squeezes and Bollinger Bounces as indicators of support and resistance points. Squeezes, occurring when the upper and lower bands contract toward the moving average, may signal an imminent asset price breakout. Conversely, bounces suggest an impending decline when the price movement reaches the upper band and reverts to the initial value. Time to unlock the secrets hidden in chart patterns. The head and shoulders is a pattern that appears as a baseline with 3 peaks, the middle peak being the highest peak, forming what looks like 2 shoulders and a head. The pattern is formed when the price of an asset is in an uptrend and then reverses, forming the left shoulder, followed by a new high forming the head, and then a decline forming the right shoulder. The neckline is formed by connecting the low points of the 2 troughs, creating an important level of support. The pattern is considered a trend reversal pattern. If the price breaks below the neckline, it could indicate a bearish trend, while a break above the neckline could negate the pattern. The pattern is one of the most widely recognized and studied patterns in technical analysis. Ew! That was a whirlwind tour of mastering cryptocurrency charts. Remember, it's not just about recognizing patterns, it's about understanding their significance in the current market. Combining these elements paints a clearer picture. Until next time, happy trading and stay crypto savvy.